So this morning, it was announced that there's a trade deal with the UK. And in that trade deal, there are lots of provisions that relate to parity and what is expected to provide better market access for American businesses into the UK. But there's also a really important piece of data there, which is that there's a 10% tariff rate for imports from the UK into the US. So this is the first time we're seeing a trade deal that actually gets announced and finalized through this whole tariff trade negotiation process that's been underway now for several weeks with all the hoopla and all the drama attached to it. And what we're seeing is that for one of our friendliest allies, for one of our best trade partners, we are keeping in place a 10% tariff rate. So if that holds with other trade deals, and that becomes kind of a standard across the board as they get more of these trade deals done, perhaps with countries that are less friendly, with more onerous, with less regulatory parity in the trade relationship between the US and that country, maybe there's higher tariff rates. What that means ultimately is that there is now maybe a pretty sizable long-term revenue stream for the federal government that didn't exist before, which means that there's room to cut taxes, which means that this is all going to be part of the calculus of the Fed's decision on whether or not and why they would need to cut rates, because this is going to drive inflation, it's going to drive GDP growth, it's going to drive employment. And so I think that there is a pretty dynamic situation at play right now. It's not just that there's a static tax revenue base and a static federal spending model, and then CPI and employment data that is going to fall down.